This is the danger of metaphor, but this is not a metaphor. This is a true story. Henry Thornton, a young investment banker in the firm of Pohl Thornton, his family was involved in the business, found himself on a Saturday afternoon, last business day of the bank, counting the minutes down to 5 o'clock because he had to close the doors before the run on his bank stopped. So he was literally watching the clock for 5 o'clock to come so he could close the doors, hoping that the bank would still be solvent because there'd been a run on the bank that day. His partners, more senior, had over-levered. They'd lent money out to ventures and basically put too much credit out, more credit than what the bank could handle. So luckily for Pohl Thornton and for Henry, the bank closed at 5. They were still solvent. But now his real work began. He had to go to the Bank of England and use his personal contacts and spoke directly to the governor of the Bank of England and was able to secure for Monday morning a line of credit of $4 billion, the equivalent of $4 billion. And that made it possible for Pohl Thornton to open Monday morning and be solvent. Now, this sounds like a very interesting story. It was a cold December day that this happened to Henry Thornton. The real story is the year that this happened was 1825. The reason I tell you this story is to say these things have gone on for the last almost 2 centuries, that we can see that these kinds of credit bubbles go through, and they happen to us on an ongoing basis. One of the signal aspects of this anecdote is it is arguably the beginning of central banking. This is the first time the Bank of England came in and rescued a bank, but this is 1825. And for those of you with a literary bent, we owe our knowledge of this story to E.M. Forster. And you know him from his many books, the English novelist. And the reason he knows about it is he edited the letters of his aunt, who was Henry's sister. And that was published in the 20th century. But we only owe that to the literary expertise of E.M. Forster and his debt that he paid to his aunt. So remember, 1825. We go back that far in trying to understand what's going on with recession, with banking problems. So what's going on in the macroeconomy? So by that I mean in aggregate. So we look at the different things that are affecting the overall economy as opposed to microeconomy, which is just individual businesses and how they interact. So the first thing I'm going to point you to is the leading economic indicators. So this shows us, if you look at the line, the red line shows the trend from March 09, looks pretty good. Looks like we're recovering. And we are. What it indicates, though, if we look into the different things that are involved in the leading economic indicators, is that it's uneven. If you look, the left-hand column is October 2008. If you look at the total monthly change, this is when the leading economic indicators were plummeting. You'll remember what was happening in October 2008. The main leading economic indicator causing that to drop was stock price. Because stock price is a leading economic indicator. It leads global recoveries or macroeconomic recoveries. But you'll see there an important factor is what was positive. If you look at the light blue line, the fourth from the top is money supply. And I'm going to talk some more about money supply. It's key to recovering from a balance sheet and understanding it from a balance sheet recession. So, what do we need to see happen before we pull out of a balance sheet recession? The first thing is the U.S. housing market. The second thing is U.S. consumer demand. The third is the stability of the U.S. banking system. And the fourth is global credit markets. I'm going to focus on the credit markets as I already have because that's what's stopping us now. That's what's stopping me from today standing here and saying everything's fine. And it's the credit markets. The U.S. consumer needs to come back or we don't have recovery. What does the U.S. consumer need to do? It needs to have certainty about where its balance sheet sits. What's the biggest part of the U.S. consumer's balance sheet? It's their house. So right now, I think you've read the papers lately, up to 25% of all U.S. homeowners have negative equity in their home. So until the housing market starts to improve, we won't see a significant recovery. But this is a good sign. We're on the right road. Now, I promised you banking system, right? We looked at the U.S. banking system and said that's got to bounce back before it does. The reason for this slide is to show you what's going on in the U.S. banking system. We had stress tests. Everybody's happy. 19 banks, the 19 largest banks in the U.S. are okay. That was the message that Tim Geithner wanted to send, the Treasury Secretary Geithner wanted to send to everybody was last February, everything's okay. Now, to a certain extent, he's right. The 19 largest banks in the U.S. have 65% of banking assets in the U.S. But bank failures in the U.S. rose to, this year, over 100. So this line, you'll see the red line, includes the S&L crisis. So that goes back, and you'll remember that from the late 80s, early 90s, we had a lot of financial institutions failing. But the blue bars are the average assets of those financial institutions that failed. So even though we had over 500 failures in the S&L crisis, their average asset amount was not even close to where we are today. So we've spiked. The average assets, the big jump there is Washington Mutual. So if you include Washington Mutual as part of that failure average, we're over $14 billion on average. Now the critical thing here is these banks that are failing are small banks. They're small regional banks. The growth in the U.S. economy comes from consumers, but half of that growth comes from small companies. Where do you think small companies get their money? They get it from regional banks in the U.S. So before we start seeing things turned around for good, before consumers are out in force, before small companies start pumping the economy again, we need more stability in the banking system. This is a slide, the global credit markets. I promised you more on that. This is something we followed very closely, and you'll see where it started to jump up. All this is a spread between the London Interbank Overnight Rate, which is an agreed upon rate that 16 banks have for global interest rates, basically. And what happened with that over this period of time is it spiked up. The implication of that is banks weren't lending money unless they got a huge interest rate for it. And that pumped way up when the crisis came. Volatility did that to them. One of the former Treasury secretaries said banks were sitting in a position where they said they had 10 bottles of water in front of them. They were very thirsty, but they knew one of those bottles was poison. They had to decide, should I drink from any of them? And their decision was no. And that's why that spiked. And what it did was it clogged up the credit system. So we're still seeing that.